The stock market has had a strong run lately. This week, it faces its biggest test yet. A wave of high-profile earnings reports and the monthly US jobs report are all landing in the next few days. Together, they will either confirm the market's recent momentum or knock it back. Start with earnings. Two major technology and data companies are set to report quarterly results this week. That matters more than usual right now because the technology sector has been the primary engine behind recent index gains. When big names in tech miss their revenue or profit targets, or warn that the road ahead looks rougher, the damage rarely stays contained to their own share prices. It spreads. On the other hand, strong results send a signal that corporate America is holding up, even with borrowing costs still elevated. That kind of confirmation is exactly what this market needs. Then comes the jobs report. The Bureau of Labor Statistics releases it at the end of the week, and it is arguably the single most market-moving piece of data on the entire economic calendar. Three numbers sit at the center of it: how many jobs the economy added, what happened to the unemployment rate, and how fast wages are growing. All three feed directly into how the Federal Reserve thinks about interest rates. Here is why that connection matters so much right now. If the jobs report comes in stronger than expected, markets may push back their bets on when the Fed will start cutting rates. A weaker report could pull those expectations forward. Either way, the reaction will be fast and it will be broad. Bond markets will be watching just as closely as stock traders. Treasury yields tend to move sharply on labor market surprises. And when yields move, the math changes. Suddenly, the return on a safe government bond looks more or less attractive compared to the risk of holding stocks. The dollar tends to react as well, which feeds back into earnings for US companies that do significant business abroad. Underneath all of this is a tension that has defined the market for months. Investors want growth to stay firm enough to support corporate profits, but they do not want it so hot that the Fed keeps rates high for longer than expected. This week's data drops right into the middle of that tension. How markets absorb all of it. The earnings beats or misses, the jobs number, the Fed signals baked into both, will say a great deal about the real conviction behind this rally. Watch Treasury yields alongside stocks this week. The bond market often signals where equities are heading before equities get there themselves. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.